A quiet but powerful shift is unfolding in the global silver market, and most investors are not fully paying attention to it yet. On the surface, silver still looks like just another industrial precious metal reacting to interest rates, dollar strength, and cyclical demand. But beneath that surface, something more structural is developing, something that has historically preceded major repricing phases in commodities. Across global trading hubs, two different pricing realities are starting to emerge for the same metal. One is centered in Western financial markets, dominated by futures contracts, leverage, and paper-based positioning. The other is increasingly shaped by physical consumption, industrial demand, and delivery-driven pricing behavior in Asia. And when these two systems begin to diverge consistently, it forces a deeper question about how price discovery in global commodities actually works. To understand what is happening, you have to look at how silver is traded at scale. In the United States, most global attention focuses on the futures market connected to COMEX, operated under CME Group. This is where silver prices are heavily influenced by financial participants, hedge funds, banks, algorithmic traders, and macro funds that are often not interested in taking physical delivery. Their objective is exposure, hedging, or speculation on price direction, not ownership of metal itself. In contrast, Shanghai's futures system operates with a much closer connection to physical settlement. The structure of contracts, warehouse delivery mechanisms, and domestic industrial participation means pricing is more directly influenced by real-world consumption needs. This includes manufacturing demand, solar production requirements, and broader industrial usage within China's enormous manufacturing base. When you compare these two systems, a structural difference becomes clear. One market is primarily financialized, where price is shaped by positioning and liquidity. The other is more physically anchored, where price is influenced by actual demand for metal. Neither system is inherently right or wrong, but they reflect different aspects of the same global market. What makes the current environment unusual is that the pricing relationship between these two systems has not been stable. At times, silver in Shanghai has traded at a noticeable premium compared to Western benchmarks. This is not a one-day anomaly or a short-term arbitrage gap. It reflects periods where physical demand in Asia is strong enough that buyers are willing to pay more for immediate access to metal than what is implied in Western futures pricing. In a perfectly efficient market, such a gap should not persist. Arbitrage mechanisms should theoretically move metal from lower-priced regions to higher-priced ones until equilibrium is restored. But when premiums reappear repeatedly, it suggests that friction exists in that process. Those frictions can include logistics constraints, refining bottlenecks, regional demand intensity, or simply the structure of how much available metal is actually free to move. This is where inventory dynamics become important. Across Western vault systems, especially those linked to COMEX, there is a distinction between registered and eligible silver stocks. Registered inventory refers to metal that is explicitly available for delivery against futures contracts. Eligible inventory, while physically present in vaults, is not necessarily available for delivery because it is privately owned and stored. Over time, registered inventories have shown a long-term declining trend. While there are periodic fluctuations, the broader pattern has been a gradual reduction in the amount of metal immediately available to satisfy delivery requests. At the same time, delivery demand has not disappeared. In fact, in certain periods, there has been a gradual increase in contracts standing for physical settlement rather than being rolled over. This combination, declining registered supply and steady or rising delivery interest, creates a subtle but important pressure point in the system. It does not automatically result in a crisis, but it does change how sensitive the market becomes to new demand surges. Meanwhile, on the demand side of the equation, silver is increasingly tied to structural growth industries, rather than purely cyclical ones. Solar energy alone has become one of the largest drivers of incremental silver consumption globally. Every photovoltaic panel requires silver paste for conductivity, and while manufacturers continuously attempt to reduce usage per unit, the total installed capacity of solar generation continues to rise at a much faster pace than efficiency gains can offset. Beyond solar, silver demand is embedded in a wide range of technologies. Electronics manufacturing, electric vehicles, 5G infrastructure, data centers, medical devices, and industrial catalysts all rely on silver's unique conductivity and physical properties. Unlike many industrial metals, silver has no perfect substitute at scale in high-performance applications. This is particularly important in China, which remains one of the largest manufacturing hubs for global electronics and solar production. When domestic factories are running at high capacity, silver demand becomes structural rather than speculative. It is consumed, not traded. And when consumption consistently exceeds domestic supply, imports become necessary to bridge the gap. China's silver supply-demand balance has increasingly relied on imports from global markets, including refined metal from major producing regions such as Latin America and other refining hubs. This creates a continuous pull on global inventories. When multiple large consumption centers are drawing from the same global pool of available metal, pressure builds across the entire supply chain. At the same time, global silver production is structurally constrained. Unlike base metals that are mined primarily for their own sake, a significant portion of silver supply is produced as a byproduct of mining other metals, such as copper, zinc, and lead. This means silver production does not respond quickly to price changes. Even if silver prices rise significantly, mining output cannot instantly scale without corresponding expansion in other commodity markets. This creates a lagged supply response. Demand can increase relatively quickly due to industrial growth cycles, but supply adjusts slowly due to geological and operational constraints. That imbalance is one of the underlying structural features of the silver market that has existed for decades. When you combine these elements, physical demand growth, constrained supply responsiveness, and fragmented pricing centers, you begin to understand why regional price differences can emerge. Shanghai reflects one form of demand pressure. Western futures reflect another set of financial dynamics. London vault systems, often considered the backbone of global over-the-counter precious metals trading, add another layer of complexity. Across all three major hubs, London, New York, and Shanghai, available inventories have shown signs of gradual tightening over time. This does not mean shortages in the absolute sense. Metal is still available, markets are still functioning, and transactions are clearing. But the cushion of excess supply that once absorbed demand shocks appears to be thinner than in previous cycles. In financial markets, thin cushions matter. When buffers are large, shocks are absorbed without visible price movement. When buffers shrink, even moderate changes in demand can produce exaggerated price responses. This is often where premiums appear, volatility increases, and market narratives shift quickly. From a macroeconomic perspective, this is happening at a time when global interest rates, inflation expectations, and currency dynamics are already in flux. The Federal Reserve's policy path continues to influence dollar strength and real yields, both of which are key drivers for precious metals pricing. Higher real yields typically act as a headwind for non-yielding assets like silver and gold. However, when industrial demand strengthens simultaneously, it can partially offset that pressure. Investor behavior is also evolving. Institutional capital is increasingly paying attention to commodity markets not just as inflation hedges, but as strategic exposure to real economy growth themes. At the same time, retail interest in physical metals tends to rise during periods of uncertainty, especially when there is visible stress in pricing structures or supply chains. Historically, similar divergences between physical and paper markets have appeared in other commodities, though not always in the same form or scale. In some cases, these divergences resolved through price increases that incentivized additional supply or reduced demand. In other cases, they resolved through temporary demand destruction during economic slowdowns. Occasionally, they were corrected through market rebalancing mechanisms, such as inventory flows between regions. What is important to understand is that divergences themselves are not predictions. They are signals of imbalance. The outcome of that imbalance depends on how multiple variables evolve over time, including industrial growth, monetary conditions, and supply responsiveness. Looking forward, there are several plausible scenarios for silver. In a bullish scenario, continued industrial expansion, particularly in renewable energy and electrification, keeps physical demand strong while supply remains constrained. In that environment, physical premiums could persist and eventually feed into higher global benchmark prices. In a bearish scenario, global economic slowdown reduces industrial consumption, ETF outflows accelerate, and financial positioning in futures markets dominates price discovery again. That would relieve physical pressure and bring inventories back into balance. In a more neutral scenario, demand and supply adjust gradually, premiums normalize, and silver continues trading within a range defined by macroeconomic conditions rather than structural scarcity or surplus. What cannot be ignored, however, is that silver sits at the intersection of monetary and industrial demand. It is influenced both by macro-financial conditions and real-world consumption trends. That dual identity makes it more sensitive to structural shifts than many other commodities. As global energy transition policies continue, as electrification expands, and as data infrastructure grows, silver's industrial importance is unlikely to diminish. At the same time, financial markets remain heavily influential in short-term pricing dynamics. The tension between these two forces is what creates periods of divergence like the one currently being observed. For investors, the key takeaway is not to assume that any single market is always correct, but to understand what each market is reflecting. Futures markets reflect positioning and liquidity. Physical markets reflect consumption and delivery. When those two diverge, it is not necessarily a signal of immediate price action, but it is a signal that something in the system is adjusting. And in silver, that adjustment process tends to unfold gradually until it doesn't. Because when physical demand becomes strong enough, and when inventories become tight enough, price stops being purely a financial variable and becomes a rationing mechanism for real metal. That is the dynamic worth watching. Not the noise of daily price movements, but the underlying structure of how silver is actually moving through the global economy. And right now, that structure is showing signs of stress that investors should at least understand, even if they choose not to act on it. The question going forward is simple, but important. Is the global silver market moving toward a new equilibrium where physical demand plays a larger role in price discovery? Or is this another temporary phase of divergence that will fade as markets rebalance? There is no certainty in the answer. But the signals coming from physical markets suggest that this is a conversation worth paying attention to much more closely than it has been in the past.